of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 1 Financial Management and Overview, Unit 1 Financial Management and Introduction, Part 2. Objectives of the firm. The company is a form of business in which ownership and management are separate. The shareholders are the owners and the board of directors is the shareholders' representative to manage the company. Different decisions are made by the management team that has an impact on the company's profitability and long-term viability. When these strategic decisions are made, what should the firm's goal be? It is the central question, and the answer of value creation always results in financial gain for owners. Because shareholders are investing their money and incurring the most risk, they expect the company to provide them with the best possible returns. The management must provide an optimum solution to three questions to achieve the goal of maximum return: where to invest and in what amounts, how to finance and in what amounts, and when to pay dividends as discussed in the preceding discussion. These elements are related to the company's investing, financial, and dividend policies. To meet them logically, the company must have a purpose. It is widely accepted that a company's financial purpose should be to maximize the economic advantage associated with the owner's financial stake. However, there is a disagreement over how to maximize the economic advantage to the owners. The two most well-known and often discussed criteria in this regard are number 1, profit maximization, and number 2, wealth maximization. Profit maximization. According to this idea, actions that increase the firm's profit are adopted, while actions that reduce profit are avoided. Increased output from a restricted quantity of scarce inputs or lowered cost of production for a certain output leads to maximization of profit. According to contemporary economics, profit maximization is a criterion for economic efficiency, since profits provide a standard by which economic performances can be judged under perfect competition. Further, under perfect competition, profit maximization behavior by businesses leads to an effective allocation of resources. Since capital is a finite resource, the finance manager must maximize earnings by making the most effective use of it. As a result, a company's purpose should be to maximize profits as evidenced by certain arguments. These are: number 1, economic activity aims at utility maximization, which is measured in terms of profits. Number 2, profit is a measure of economic efficiency. Number 3, profit leads to the efficient allocation of resources. And number 4, it leads to efficient use of important and scarce resources. As a result, it is stated that profit maximization should be the primary criterion for final financial management decisions. Limitations of profit maximization goal. Number 1, ambiguity. Profit maximization is a rather ambiguous and inaccurate goal. Profit has a wide range of meanings and various people perceive it differently. Profit, for example, could be short-run profit or long-run profit, total profit or rate of profit, after-tax profit or before-tax profit, return on equity or return on total capital employed. Hence, there will always be a dilemma as to which of these variations of profits should a company try to maximize. Number 2. It ignores the timing of benefits. Profit maximization ignores the fact that investment rewards arrive at different times. The goal makes no difference between two alternative projects with different profit time patterns. The profit maximization goal hence ignores the time value of money. Number 3. It ignores the quality of benefits. If the predicted earnings are more assured, the quality is high because the range of fluctuation is small. Profit maximization ignores the value of benefits and does not consider the risk connected with the profits. The profit maximization goal is unable to differentiate between various ventures. Hence, profit maximization cannot be an objective in the end of itself, even if it is a disadvantage to the owners or the shareholders. The incremental profits may not result in a rise in earnings per share if a firm invests in new initiatives by raising additional money, diluting the capital base through the issuance of additional shares. If the new project's return is lower than the company's previous earnings, then earnings per share or EPS will fall. The pursuit of huge profits may lead to the company's liquidation as it entails a high level of risk and it is against the shareholders' best interest. As a result, profit maximization is not regarded as a viable goal. The goal of EPS maximization is additionally limited by certain factors. They are: Number 1. It does not specify the time of expected returns. Number 2. It does not consider the risk associated with future earnings. And number 3. It does not consider the financial risk. Given this discussion, it is evident that the profit maximization idea is incomplete for a corporation in terms of financial decisions such as investment, finance, and dividend policies. It is not only confusing and unclear, but it also ignores the two fundamental components of risk and time value of money. The most appropriate operational decision criteria should consist of certain aspects. They are: Number 1. It should be precise. Number 2. It should consider both the quality and quantity dimensions of the receipts. Number 3. It should be based on the bigger the better principle. And number 4. It should recognize the time value of money. An alternative to profit maximization which addresses these issues is the wealth maximization objective. Wealth maximization. The firm's most widely accepted goal is to maximize the value of the company for its shareholders. The reasonable guide for conducting a business is the maximization of shareholder wealth. According to the wealth maximization goal, managers should strive to maximize the present value of the firm's expected profits. The discount rate or cost of capital is used to assess the present value of future rewards, which considers both time and risk. As a result, the discount rate or capitalization rate used is the rate that represents the temporal and risk preferences of capital sources. The wealth maximization criterion's second aspect is that it considers both the amount and quality aspects of benefits as well as the time value of money. When all other factors are equal, certain income is valued higher than income that is uncertain. Likewise, benefits gained earlier in life should be regarded higher than the advantages acquired later in life. Thus, the objective of wealth maximization has several distinct merits. It is undeniable that the goal of wealth maximization is superior to the goal of profit maximization. A comparison of the present value of future benefits to the cash outflow is used to achieve the wealth maximization goal. If an activity has a positive net present value, meaning the present value of future cash flows exceeds the present value of outflows, reflecting both time and risk, it is considered to build wealth and should be preferred. Actions that have a lower value than their cost, on the other hand, deplete the firm's wealth and should be avoided. In the case of mutually exclusive projects, when one only of the projects is to be chosen, the alternative with the greatest net present value should be selected. Wealth maximization concept is more robust concept than maximization of profits, as it incorporates both the timing of cash flows and risk associated with these cash flows. Implications of wealth maximization. It aims at the prosperity and perpetuity of a company. It helps in measuring the performance of a company. It helps in the allocation or reallocation of scarce resources. It helps the company in discharging its other responsibilities effectively, such as consumer protection, payment of fair wages, provision of safe working conditions, environmental protection, support for social problems. It leads to efficient use of scarce and precious resources, and it considers risk associated. Risk-return trade-off. The firm's financial decisions are interlinked and therefore they influence the market value of its shares by impacting return and risk. The formula for expressing the relationship between return and risk goes as return equals to risk-free rate plus risk premium. The risk-free rate is the compensation for the time that the investors part with their saving. Proxy for risk-free rate is generally the return earned on government securities of similar tenure. The risk premium is paid for risk coverage. A healthy balance between return and risk should be maintained to optimize the market value of the firm's shares. A risk-return trade-off is a term used to describe such a balance. Financial goals and firm's objectives. A question may emerge in the shareholder's wealth maximization criterion. Is the firm's goal to maximize its wealth? Is there a company that exists solely to serve the interests of its owners? The primary goal of business firms is not to maximize shareholder wealth. The firm's survival and future growth are always dependent on how well it satisfies its clients by providing high quality goods and services. In addition, organizations in practice define their vision or mission in terms of technology, leadership, market share, image, employee welfare, and so on. As a result, the company bases its strategy on such fundamental goals as technology, production, purchasing, marketing, and finance. For this, the company makes decisions that are in line with its objectives. As a result, the wealth maximization objective is the second level criterion, ensuring that economic performance meets a minimal norm. The management serves as both an agent for the owners and a trustee for the other stakeholders. As a result, the management must balance the interests of the owners with those of creditors, employees, the government, society, and so on. Conflict of goals, management versus owners. The management of a joint stock corporation is responsible for making decisions. Management may not behave in the best interest of the shareholders when making decisions. They might pursue their interest, job security, and so on. In other words, there may be a misalignment between the shareholders' goal of wealth maximization and the actual aims followed by the management of the firm. The separation of ownership and control management roles in these organizations has been identified as the key reason for this conflicting situation. However, pursuing just the management's interests is unlikely because management's ability to act in their interests will be limited by constant scrutiny by owners, employees, creditors, customers, and the government. From their point of view, each group associated with the organization will evaluate managerial performance. The management's survival will be jeopardized if the organization's aims are not met. The wealth maximization criterion could be aligned with the interests of the organization's stakeholders in general. However, there may be a contradiction between the shareholders and management's ambitions, in which case the management may play it safe and create adequate wealth for the shareholders rather than the maximum. Such a management's attitude towards the shareholders' goal will sabotage the goal of maximization of shareholder value. Organization structure of finance function. The finance function is an essential component of any business and it is linked to all other management functions such as manufacturing, marketing, and human resources. Specific tasks are carried out by specialists in the field of finance. Because the finance function is a major functional area, top management is ultimately responsible for carrying out these functions. However, the exact nature of the finance function's organization varies from firm to firm based on criteria such as the size of the firm, the nature of the business, the skill of the financial executive, financial philosophy, and so on. Similarly, the title of the financial department's top executive varies greatly depending on the company. They are known as finance managers, vice president finance, director finance, financial controllers, and so on. Controllers and treasurers report to the chief executive and are in charge of the firm's sub-functions such as accounting and control, and financing. The treasurer's responsibilities include obtaining financing, maintaining relationships with the investors, banks, and other financial institutions, short-term financing, cash management, and credit administration, while the controller's responsibilities include financial accounting, internal audit, taxation, management accounting and control, budgeting, planning and control, economic appraisal, and so on. Role of finance manager. Some of the responsibilities of the finance manager of a company are: number 1, to estimate capital requirements for various projects and offers to fund for them. Number 2, to maintain liquidity and solvency to fulfill short-term and long-term obligations. Number 3, to keep in contact with the stock exchanges, stockholders, bankers, and financial institutions. Number 4, to estimate the risk and propose alternative risk reduction strategies. Number 5, to take established practices into account while deciding on credit policy. Number 6, to report to external agencies, viz. Financial institutions, tax authorities, government, etc. Number 7, to meet numerous duties under various laws such as tax laws, SEBI, and so on. Number 8, to arrange for an internal audit to be carried out to ensure that suitable checks and controls are in place. And number 9, to decide the dividend policy of the company. All of the aforementioned responsibilities are expected to be carried out by the financial manager within the confines of the applicable legislation to maximize shareholder wealth. Finance and related disciplines. Finance on the one hand and other related disciplines and subjects on the other are inextricably linked. It makes extensive use of related disciplines and fields of research. Accounting and economics are the most important areas which are closely related to finance, although areas like marketing, production, quantitative methods, and so on also have an impact on finance. The relationship of finance with these disciplines is discussed in the next section. Number 1, finance and accounting. Finance and accounting are closely related to the extent that accounting is an important input in financial decision making. Accounting is a crucial component of the financial function. The financial statements are used to generate data. The information in these statements aids financial managers in evaluating the firm's previous performance and potential directions, as well as meeting certain regulatory requirements. Accounting and finance are thus functionally intertwined. The fundamental differences between finance and accounting in terms of the treatment of funds and decision making are: number 1, treatment of funds. The accrual principle governs the measuring of funds in accounting. For example, revenue is recognized at the point of sale rather than on credit collection. Similarly, expenses are recorded when they are incurred but not when they are paid. In finance, however, the treatment of funds is based on cash flows. That means here the revenue is recognized only when received or paid in cash. Number 2, decision making. Accounting is concerned with collecting and presentation of financial data. This information is used by the financial manager to make financial decisions. It does not imply that accountants or financial managers never make choices or prepare data. However, accountants' primary role is data gathering and presentation, But the financial manager's primary role is financial planning, controlling, and decision making. As a result, finance takes over where accounting leaves off. Then comes economic and finance. The study of the theory of the company in economic theory led to the development of the theory of finance in the 1920s. When building decision models that are likely to lead to the most efficient and successful modes of operation inside the organization, the financial manager uses microeconomics. Further, the marginal cost and revenue concepts are used in making investment decisions, managing working capital, etc. in the finance field. Now let's summarize the unit. In this unit, we have tried to introduce you to an overview of financial management, emphasizing its importance in a firm. We also talked about how the previous notion of corporate finance, which focused solely on the provision of finances to a business, has been replaced by a modern approach that views finance as an integral part of total management rather than just raising cash and the scope of finance. The emphasis then shifted from soliciting funds to efficient and effective use of finances with a focus on managerial issues. Profit maximization and wealth maximization goals have been explored as well as their importance. Finally, we understood how finance functions are organized and associated with finance disciplines. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.